Hey, beautiful souls. If you're a coach, healer, or conscious entrepreneur who's tired of the money is evil programming and you're ready to build a healthy, loving relationship with your finances, this video is for you. I'm Andrew, and about 10 years ago, I was working corporate, exhausted, and had zero clue how money could actually work for me instead of against me. And then I discovered the most boring wealth building strategy that actually works. Today, I'm sharing my entire personal journey of how I went from financial confusion to building wealth that supports my coaching business and my soul. Not because I'm some finance guru, I'm not. I'm still learning, I'm still growing, and I'm still figuring all of this out. But here's the thing, the coaches that I mentor kept asking me to share this stuff. Because these boring, simple systems helped me save for my first home, build financial buffers for my coaching business, and create actual abundance without the stress or overwhelm. Fair warning, this video is quite long because it's a live session that I ran with the coaches that I mentor. But I put chapter markers so you can jump to what interests you most. Whether that's money management, superannuation, investing outside super, or even a simple crypto strategy that doesn't require you to become a day trader. There's also a link in the description to a comparing calculator I whipped up using AI. It's not perfect, but it'll show you why starting early matters so much, even if you're starting later like me. Now, there's a quick disclaimer here. I'm not a financial advisor. This is just one coach's journey. So do your own research, speak with professionals. But if you want to see how spiritual abundance can meet practical wisdom, let's dive in. Because your relationship with money, it's a love story waiting to be written.
For her, it'd be the idea that she's a very savvy saver, not the most savviest of investors. Yeah, beautiful. Tracy, the more curious I become about how you can make money, the better my relationship money. Absolutely. It's like a love relationship, isn't it? The more curious you are about your partner, the better the relationship. Yeah. And then what does Tracy say? I have regrets about believing for so long that to grow wealth equals good job, and this was the only way. Oh, I so get that. I so get that. Yeah, absolutely. Not healthy with investment, but good at saving. Yeah. So I think there is also a generational thing as well, where post-World War II, people of that generation, like mom's generation, and also older Gen Xers, where we're better at saving, but not at investing. Yeah. Work hard and grind, only way to make money, a strong energy. Yeah, absolutely. Absolutely. Which you can see is very masculine, isn't it? Yeah, and we all know that abundance can only come when masculine makes love to feminine. Yeah, and also interestingly, in the archetypal process, the creative nurturer is abundance. Yeah, in fact, like creating money is creative nurturer, is actually feminine. And the ruler is about the money that's being created or the money that's being born, that's been given birth to. How do we structure it in a way that it can flourish? Yeah, that it can flourish. And that's basically the essence, I think, of what I want to share with you guys today, because I've used, and this is only one part of the story, it's only my style of investing that's helped me save up for my first home, which I'm so glad I did because it's helped me now create. I stayed here, it's got good capital growth, and at the same time, in the times when my business hasn't been the best, I've got a good offset account to be able to draw cash flow. Yeah, because when you own your own business, cash flow is king. Cash flow is king. So I'm only going to be sharing one perspective. And at any point, if you guys have ideas, you have questions, things you want to add, please stop me and then we can share and learn more about money and being more curious about building the structure for our income to grow. Yeah, if that's okay with you. Yeah. Kat said, I've just improved my relationship, changed a lot during super funds, lawyers, and more to ensure it was more nurtured with the right structure and support. Absolutely. And super, I think, is one of the most beautiful things. Whoever created that really understood human psychology. Yeah, because it's basically saying we're going to put that money and put the money in prison temporarily. So you can't do shit with it. And there's always sorry, Christine, you wanna?
You can if you have a self-managed super.
That's right. I'm going to talk about that too. And you can if you have self-managed super. But in order to have self-managed super, you need to have some sort of ruler in the light to get yourself to the stage where you've organized your self-managed super. Plus, there's rules and regulations that you have to follow and processes that force you to move monies in the right process. So you got to have ruler and a light in order to even have the self-managed super fund work. So whoever also thought of self-managed super fund was the ruler looking at the creative nurturer. Yeah, and saying, yes, of course, we don't want the structure to be so rigid. And at the same time, we need a structure. So yes, self-managed super fund is the creativity within the structure. Yeah, freedom within the structure. Absolutely. Absolutely. So I'm calling soul meets strategy, saving, investing, and growing your coaching income. And spiritual abundance meets financial wisdom is the tagline that I've used. Now, I'm just going to do the usual disclaimer. This is not financial investment advice. It's only my personal perspective. Yeah. Before making any money related decisions, please do your own research, speak with a qualified professional. But there are also many qualified professionals out there that are also very limited in their limiting beliefs. And I've seen that happen with my friends who've paid for professionals giving them advice that hasn't really worked for them. Not because the advice isn't right, but because the advice isn't right for the particular client. Yeah. Yeah. And but then we've talked about it, and then she's also been more savvy with it. Now, some of you here are very good at property investing. I have close to nil knowledge of property investing, so this is totally out of scope for what I'm sharing with you guys. Yeah, cool. All right. So the areas I want to cover, and I was very purposeful in prepping this presentation. I only did it this morning, that it is one coach's journey. So take what you want and ask questions. I've also found that I've always listened to other people, but it has to be, just as with anything in life, it has to be aligned with who I am and how I feel. So I always test things out, and I always test things out with a very small amount of money. Yeah. And I call it my education tax, in a sense that if I lose that, it's all okay. Yeah. And sometimes my education tax is also what I lovingly call my dumb tax, because I made a lot of mistakes through that journey too. Yeah. So I'm going to cover these areas. One thing is just money management. Yeah. Then we talk a little bit about super. I won't go into nitty-gritty details. I'll just tell you what my mindset is, my thinking behind it at a very high level, and what I actually do. And then you guys can jump in, yeah, about super. And then also outside super, what I do in terms of investing in the share market. Yeah, that's my main instrument. And then I'll show you the magic of compounding. We all know this, but when you look at the numbers, we just go, I have a mission personally that any young person that I speak with, even if they don't take action now, they need to know about the magic of compounding. They need to know, yeah? Because if they start early and they just invest a very small amount, by the time they reach a certain age, they would have a seven-figure nest egg, yeah? And looking back, I just go, I wish I'd learned that. But at the same time, I also know at that time, when people did tell me, I could have ignored it or just went over my head, yeah? And finally, I show you some examples of investment platforms that I have actually personally used, some pros and cons, yeah, particularly for those who are starting or might think about switching their strategy a little bit. Yeah, cool. All right, let's talk about money management. All of my money management concepts come from the Barefoot Investor because I like his style. It's very simple. Yeah. Now, what is his style? His style is, and I'm just going to expand this a little bit. I hope you can read it. Some of the text in these slides are a little bit small because I only did it really quickly as a draft form, and then I experimented with a new AI that beautifies your slides. So you just do it and then it formats everything. So all of this font and all of the background and all that kind of stuff was done by the AI in 15 minutes. So interesting. I'm experimenting with it at the moment. Once I have a hang of it, then I will share with you guys. Yeah. So his idea is this idea of bucket summary, where he says you got 100% of income coming in. Yeah. And you want to put it into first of all, a transaction account that's fee-free. Yeah. And the one that I use is ING Direct. Now, ING Direct 5 years ago, or actually 10, 15 years ago, was a much better product than it is now. It's still not bad, I still use it for most of what I need. Yes, all 100% of income comes into here. And he says that we should allocate no more than 60% for daily expenses. And then what do we do with the rest? So first he says, you got to make sure you put 10% of anything that comes in into your short-term splurge. Yeah, human psychology. You have money, you want to reward yourself, 10%. Yeah, so dining out, entertainment, have fun, saving up for a subwoofer that I don't really need, but I want, you know, that kind of stuff. Yeah, yeah. Or I have this new little camera that I just bought recently, where basically it's like a lanyard on my around my chest, and then it's got a little magnet that sticks onto it that I can just basically capture what I'm doing, point of view of a person. So for vlogs and stuff like that. So I'm going to experiment with that with my business to just show people what I do daily. Yeah. 10% for splurge. And then he goes 10% for smile, which is long-term things like holidays or a big investment. Like one of my friends who's a doctor, he is obsessed about Tesla and sustainable cars and all that. So every time he buys a car, it'd be this $75,000 new car. Yeah, but he's got the money for it. And then he's got a way where he invests over the longer term. Yeah, that's smile. And then he also says 20% should go into fire extinguisher, which is like emergency funds. Yeah, so nice and simple. 20, 30, 40, and then that's 60%. Yeah, so 60 plus 40% there. But he also says you want to also put the money into what he calls a mojo account. So account that you put aside and you save between 2 to 6 months of your wages or your expenses. Yeah, just in case. So even though you got an emergency over here, you have another buffer for 2 to 6 months. I quite like this whole concept. Yeah. And recently, in new editions, he says, and of course, out of your 60%, if you can, invest at least 9.5% of your wages into the Grow bucket, which is an ultra low fee super fund. And he mentions an index fund, and I'll talk about index funds in a little while. Yeah, 9.5%. Now, this is what he recommends as the generic concept. Any questions here? Yeah. Now, this is really powerful because every time without fail, and I know it seems tedious, but it's the way I love my money coming in. Because if there's money coming in and there's a loving relationship, just like a partner, I want to spend time with the money. And spending time with the money means whenever I see a notification on my email that there's money coming in from Stripe, first of all, I'll open the email and I'll look at that email with gratitude. Now, I don't know whether it works or not, but I just love the idea that I'm receiving something with gratitude, just like I'm welcoming my partner home. Then I never delete my Stripe emails. They're always archived so that when things are not going well for me, because I know law of attraction is about attracting money, right? I will search my email account for Stripe and see all the emails that have come in because that shows me that I'm capable of generating income. And if at this moment my income is not as good as what it was, I have the capacity and resources to get that and more because I've done it before. So that's my strategy. Cool. Secondly, in the mojo, he actually mentions at that time when he wrote the book that it would be $2,000. But I make sure that there's at least $10,000 in there. But $10,000 is like only 1 month of my income. So I try to put in at least $60,000 for me anyway in my Mojo account. And my Mojo account, to make it work for me, is actually my mortgage offset account. Yeah. So at a minimum, my mortgage is offset by $60,000 of interest. Yeah. Of interest offset. Yeah. Now, I also modify the system a little bit in the sense that my splurge, smile, and fire extinguisher are also placed into my mortgage offset account. Yeah, because I want to reduce as much interest as possible in there, but I can also put it in my actual account because I've got redraw. But as a business owner, where cash flow is king, I want to make sure that this is funds that I want to reduce my interest. At the same time, in times of winter, in the cycle of winter in my business, if I need to draw from the shed, my harvest, I can. And I just keep track of what's splurge, what's small, and what's fire extinguisher in my offset account. so that I know, oh, I've got $10,000 in Smile now, which I'm saving up for something, and I can use that if I want to. Yeah, does that make sense? Yeah. And then the other thing that I change is that he says 9.5% of my wage goes into my super. Now, I'm really lucky that for quite a few years I was working for the government, so I got quite a bit of super already accumulated, which I'm really lucky. Yeah, there's my contribution plus the government contributes there plus now 2%, all that kind of stuff. Yeah, for now, I always try to put in at least 20% of my income into super when it comes in. But there are some times where it's 10% or 15%, and I just trust my intuition, depending on what my cash flow is for that month. Yeah, I'll decide that I might put in less, but I always put in at least 1%. That's my rule. Yeah. Now, the other aspect of super will be there's so many super funds out there, and they give like investment mixes of all sorts. What do you pick? So I am quite risk tolerant in terms of the stock market, and I'll show you why in a moment. That because I believe in the certainty that no matter what happens, no matter what crashes happen, the market will always rise. Yeah, so I go for aggressive. I've always gone for aggressive. Once I learned about it, I've always gone for aggressive. However, if you are at the later stages of your life, then you might decide you want to go something less than that. It's entirely up to you. But I always go aggressive because I also have savings on the side that when it's time for me to draw on my super, I can wait if it's not at the level that, that the stock market is at. Yeah, cool. And then the next thing is, even within aggressive, you have choices within that fund on how you break down your investments. Now, I like to keep it really simple. Most super funds, have investment mixes that are called indexed funds or index instruments. Now, in the past, not all super funds had that. And my recommendation is if your super fund doesn't have index investment options, you should go to a different one. Because, and I'll show you evidence, index investments, and I'll explain why it is in a moment, index investments outperform 85 to 95% of the time over other sorts of investments. Yeah, which is why most super funds now offer that option because people are getting smarter, and they are demanding their super funds to offer investments that perform better. Yeah, and in my super fund, I do make it really simple. 10% in property, 10% for Australian shares, and 80% for international shares, of which a bulk of this, most international shares index, a bulk of that is the US because the US is a large part of the market. Yeah, and I keep it really simple. So 10, 10, 80, making it 100. So every time I invest $100 into my super, it'd be broken up into $10, $80. Yeah, and it just does it as it is. Any questions about this?
I have
Yes,
a
just a
question.
quick one.
Oh, go on, you go, Kath.
Sorry. Is the way to tell, I won't pull it up now, whatever, but say I've got some super in with Australian super and it's a more balanced approach because I'm a bit not
Yes.
as risk
Yeah, yeah.
tolerant.
Yeah.
So the way that I would find out is to look at the wording because it's got a split between
Look at
international,
in the
domestic.
balance. Yeah, in the balance, it should break up into like X% for international shares, X% for domestic shares, X% bonds, X% for whatever it is. It should break it up, but it should also explain within those segments whether they are actively, and they'll use words like actively invested, designed to outperform, and this is the word that they use, to outperform the index. When it says something like outperform the index, then it is not an index fund.
Okay.
Yeah, it's not an index fund. Now, I'll explain what it means by trying to outperform the index in a little bit. It is not an index fund. When it says to match the index, then it's probably an index fund.
Okay. All right.
Matching the index, not outperforming it.
All right. Thank you.
So then, like in Australian Retirement Trust, which is what I'm in, they have a balanced one, which is not index funds. So I decided I was going to go custom, and create my own segments. And you can, like, for example, in your situation, Kat, you can look at the balanced, what the segment, let's just say it's, I'm going to go most super funds that are balanced would have maybe 30% Australian, 20% international, 20% bonds or fixed interest, 20%, 10% property and whatever it is. So they'll break it up. Yeah. Then you can, if you wanted to, go, okay, now that I know what the mix is for balanced, then if they have an option for me to choose or customize it based on their index offerings, I will use the same percentage as a balanced, but choose the index component. Yeah, choose the index component. So you're basically following their methodology, but using index instruments for investing. Yeah, cool. Tracy?
I've got two things. The
Mm.
first was I thought, because you said 1 to 20% into your super,
Yeah.
I thought you had to put like the minimum, what is it, 11 now or 11 and a half? But I didn't realize you had the option to put in less.
Yeah, so if you're a company, right, then yes, if you are a company and you are an employee and treated as an employee of the company, then yes, you have to put in, there's company rules, and you guys who know this will be able to tell me a certain amount. I've been operating as a sole trader.
Right.
Yeah. So
Yeah.
then I decide that I'm just going to put in because I made that decision. So
Mm.
I'm really good with my insurances and all kinds of stuff so that I'm protected as best as I can.
Yeah.
I want the cash flow to be able to manage that. So I've decided to do it that way.
I got it. I got it now. If you're a sole trader, you can put in whatever you can
Yeah,
put
you can
in.
put in whatever you want.
I
Yeah.
didn't know that. I thought sole trader you still had to put a certain amount in. Didn't realize that. Okay.
No, you don't have to. Yeah, you don't have
Mm.
to. Yeah. Because
Okay.
what you're doing, also, I'm investing like a post tax. So I've already paid for tax. In fact, if you do it this way, it's called a voluntary contribution. There's a maximum amount that you can put in each year. And they've raised it. I think I'm not sure. Please don't quote me. I think it's about 75,000 or something each year that you can put in. Yeah, it used to be like less than that, but now it's higher. Yeah, cool.
I've
Yeah,
got another question.
yeah.
Looking at my breakdown in my super, I have no idea if any of them are indexes or whatever, because none of them have the word index in them. They're either
Yeah.
funds, trusts, or something like unhedged equity or something.
Yeah, so if you look into the PDS, the holdings, the actual definition, oh, it's 100,000. There we go. Thanks, Christine. Yeah, if you look at the definition of that portfolio, it should tell you. And if it doesn't tell you, you can actually ask your super specifically what is being invested there. And if it's not clear, I would actually be worried about that too.
Okay.
Yeah, like they should really be transparent in telling you what they're investing in terms of sectors, whether it's international, local, or whatever it is, or property or whatever, or fixed term or bonds, they should tell you. At the same time, they should tell you whether those investments are indexed instruments or trying to outperform the market, actively
Right.
invested. Yeah. Yeah.
Okay.
And I'm sure you can ask.
Yeah.
I would just go, hey, blah, 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 blah. Can you tell me within each of those sectors, are the investments actively managed or are they indexed investments? Just ask.
Okay.
Yeah. Cool. Any other questions? Cool. Okay. So I'll move on. Okay, cool. So I think superannuation, I like the analogy, is your wealth tree. You plant it today and you harvest it in abundance later. And there are huge advantages. With my business income, I'm being taxed as 30%. But if I put it into super, it's only 15%. So half. Yeah. And then the compound growth over decades, I'll show you a graph later on. It's just amazing. And then of course, if you have an employer, then they also sometimes they'll match. So it's a great way. Now there are a few action items though. You want to make sure you don't have multiple super accounts because multiple super accounts means you have multiple fees that you're paying, plus you're paying for multiple insurances. And if your super account is any good, there should be an option to say consolidate your super, where the super will do a search for you and then make it really easy for you to consolidate your super into their fund. Yeah, because it's to their advantage that there's more money coming to them. So make sure you consolidate multiple super funds. And then, of course, choose your appropriate investment option, whether it's low risk, balanced, or aggressive. Now, I go aggressive. Yeah, cool. So how do I see super contributions? Super contributions are love letters to your future self. Cool. Now, outside of super, I think it's also important to look at how you can build wealth outside of retirement accounts because super does have some constraints. It's locked until your preservation age. For most people, 60 or 65. Yeah. There's annual contribution caps if you're doing voluntary contribution. Like in this case, Christine said 100,000. Yeah. And then there's limited investment control unless you go self-managed super fund. Yeah. And also there might be government rule changes. We don't know. So super is powerful, but it does have its boundaries. Yeah. Outside of super, if you invest outside of super, the money is there when you need it. And there have been once in the last 10 years, 8 years of running my business where I need to, Andrew, you need to like make this small sacrifice and sell some of your shares to top up the cash flow for the next 3 months because you are traveling and all kinds of stuff. Yeah. Oh, that's a good one to know, Christine. You can put in 3 years in advance or in arrears as well. So that means basically you can put in 300,000 if you want it. Is that what it's saying? Yeah, beautiful. Yeah. So put that in. Yeah. There's no contribution limits if you invest outside of super fund, and there's also some tax flexibility in a sense that if your shares are at a loss, you can sell them at a loss to reduce your income for that year. And that is especially useful when you are in the cusp of a tax bracket. So let's just say if you were going to be taxed at 30%, but then if you sell something at a loss, it will have brought your income down a little bit to be taxed at a lower rate. Then there are some tax advantages there. Right. Now, I don't look at those things. If you wanted to, you speak with an accountant and look at that. So that's some of the advantages. I don't usually sell a lot of my stuff, so I don't really look at that. Yeah. Before you invest outside your super, though, I think it's really important for you to have your emergency funds first. So your Mojo account, as well as your fire, like your fire extinguisher account every 20%, and also your Mojo account. Yeah. Which I believe 3 to 6 months buffer would be great if you can. Yeah. I believe that when you invest outside of super, that you look at low-cost index funds or index ETFs, and then you increase investments as you go. And this roadmap that I'm showing you complements super. It does not replace super. Cool. Cool. Now, if we talk about investing outside of super, there's two main types of investing in the share market. You either look at active investing or passive index investing. Now, let's look at active investing. Active investing basically means I can beat the market. That is the belief behind it. So whether you are investing by picking individual stocks or managed funds, or investing in managed funds that are active, that means the managers of those funds are actively managed, are active managers. Their aim is to beat the market. Yeah. So there is a person picking the stocks, yeah, on the basis of some analysis that they have that it will perform better than the overall market. And because there is someone doing the picking, they will charge a higher fee because they got to pay that someone. Yeah. So there'll be higher fees, and there'll also be more frequent trading because they'll make the analysis and they go, oh, I'm going to sell this, I'm going to buy this, I'm going to sell this, I'm going to buy this. Right? Now, higher fees will affect your return, and frequent trading will also affect your return because every time you trade on the stock market or on the share market or through a broker, there are fees involved. There are transaction fees. Yeah. So the more you trade, the more your capital, part of capital will be eroded from frequent trading, and requires constant research. You have more control, of course. Yeah. And you can do this through actively managed funds, that is through a funds manager, or individual stocks through a stockbroker. And there are pros there. There is a potential to outperform the market, of course, and you can adapt to market shifts. So for instance, at the moment, AI stocks are doing really well. So a funds manager would invest more in AI related stocks. Yeah. Until, of course, the next bust for AI. Yeah, because that happens. That's the nature of market. Now, the cons are, and I'll show you research, and I've checked this and I've all that. Most fail to beat the index. And even Warren Buffett says, for the normal investor, do not try to outsmart the market. Yeah. So higher fees and taxes reduce returns. The other alternative, which is passive index investing, which is I'll own the market and let it work. So you're not really trying to pick the stocks. You are saying, if this is the market, I'm going to invest in the market. And I'll show you what I mean a bit. Because it is just in the market. Like, for example, in Australia, there's an index called the ASX 300, which is basically the top 300 companies in Australia. So if you invest in ASX 300 index, you are basically investing in 300 of the top largest companies in Australia. So no one makes a decision because the Australian Stock Exchange has already done the analysis and identified which the top 300 companies are. And if any market drops off the list and another one comes up, it's already determined by ASX. So therefore, the fees are really low, and you are investing in basically the top 300 companies in the same percentage as their composition in the index. For example, if BHP is a large company and therefore they comprise 10% out of the index, whereas Woolies might be a smaller company and only comprise 5%, then when you invest $100, $30 will go to BHP, $5 will go to Woolies. So all those decisions are already made by an independent body. Yeah, that's why I love it. My ruler loves this. Yeah, low fees and only minimal trading. It's a set and forget approach, and it embodies trust and surrender. Yeah, you invest it through index funds, through a funds manager or index ETFs. The pros are 85% of the time, they beat most active funds over the longer term, and lower fees compound wealth faster because more of your capital is being used for investment. Yeah. The cons is it will never beat the market. It will never beat the market because it's designed to just match the market. It will never beat the market. And there are no protection in downturns because when the market shifts, active investors will try to move things around and invest in more conservative assets. But there is no protection for downturns in the index market. So you need to be able to trust and surrender that the market will rebound. Yeah, cool. So I did a whole bunch of research and all the details are here, and I'll put this set of slides in your learning area so you can have a look at it. But basically what it means is this. In the short term, the research shows 60% of actives underperform the index in the short term. Yeah, so active managers, 60% of them underperform the index. Yeah, and then to top that off, active funds charge between 0.6 to 1.2 or more. In fact, even more in Australia. I don't know why, but Australia's fees are much higher than our US counterparts. Some active funds are like 3% or 5%. Whereas index funds are between 0.02% to 0.06%. This is US. In Australia, it could be at 0.1 or 0.2 or 0.3. And yet, if you look at that, right, 0.02 to 0.6, right, it's 30% more. Can you see? 0.02 times 3 gives you 0.06, and then you got times 10. So it's 30 percentage points higher in terms of their fees. Yeah, so it's really a drastic difference between 0.02 and 6. It's the difference between 2, move to 2 points, and 60, basically. Yeah, the implication are the odds are already against active funds, but the cost itself makes it worse. That's in the shorter term. Over the longer term, in 10 to 15 years, over 95% of active funds fail to outperform index funds. And then you've got costs as well that drag down returns. So long term, the odds are overwhelmingly favoring passive. Now, there are some exceptions. During the boom market, mid cap or small cap, which are emerging companies, the smaller companies like AI, for instance, they outperformed the index in 2024. However, the active fees are much higher for mid to small caps. Yeah. And at the same time, I wouldn't recommend investing a large part of your money into mid companies and small companies because they're likely to fail. Yeah. Small companies are startups. Yeah. So if you want a percentage of your investment, for sure. Yeah. If you look at your balanced portfolio, most of super funds balanced portfolio probably wouldn't have small cap in it. And if they do, it'd be a very small percentage, like 2 or 3%. Yeah. So there are occasional short-term wins, but not sustainable. So what is passive investing? I like to think of it that way. ASX 300 is like Australia's top 300 playlist of songs. Each company is like a song on the playlist. The most popular songs, like BHP, Commonwealth Bank, CSL, are played louder and more often, so they have more influence on how the playlist sounds. The less popular songs, smaller companies are still on the list, but they don't shape the vibe as much. So the index number is like an average rating of the playlist. If most songs are hits, the rating goes up. If most songs flop, then the rating goes down. But the investors don't have to check every single song one by one. They just look at the playlist rating to know how the whole music scene is doing. So it's basically a measure, just like consumer price index, a measure of the performance of the share market. That's it. It's just a measure. So in Australia, we have the ASX 300, which is Australia's top 300 companies, and top three are Commonwealth Bank, BHP, and Woolies. In the US, they have what they call the S&P 500 index, which is America's top 500 companies. And in the index are things like Apple, Microsoft, and Amazon. Now, there's also global all-cap index, the FTSE Global All-Cap Index, and that covers around 9,500 or 9,500 companies across developed and emerging markets worldwide globally. So that covers Apple, Nestle, and Toyota. So you can see there's American there. I don't know where Nestle is. It used to be English, I think, but it might be American now. Toyota is multinational based in Japan, right? So already in these three indices, oh, Swiss, here we go. Yeah, obviously with the E and the little thing. Yeah, with these three indices already. So these are the indices. Then we look at what funds are being offered to match the indices. Yeah. So based on those three indices, the three most popular funds are in Australia, Vanguard Australian Index that matches S&P ASX 300. The ticker is VAS. In the US, the S&P 500 is matched by a fund called the Vanguard. It's also a Vanguard fund, VU. Yeah. And then, or actually, all these three are Vanguard funds because Vanguard was one of the first companies, their flagship product was index funds. Yeah. And VT tracks the FTSE Global All Cap Index. So literally, if you invested in any one of these or all three of these, you are investing in these three, one or more of these indices. Okay. So let's talk about their performance. Yeah. I have basically asked AI to create a little app for me. And I'm going to run it for you just to show you. And I'll give you the link as well so that you can have a look at it if you want.
I'm a bit confused at that point. Sorry.
Okay, here we go.
So let's do just the ASX 300, the Australian one.
Yes.
I don't understand when you say the fund that matches it. I don't get what the difference is. Aren't you investing in if you're investing in the ASX 300?
You can't invest in an index because an index is just a measure that's provided by the stock exchange body.
Yeah.
So the Australian Stock Exchange creates a number of indicators that show us how the market is performing.
Yeah, got that.
And one of the indicators is called the ASX 300.
Yeah, got that. Yeah.
Okay? Yeah. Then investment companies will then create a fund.
Oh,
and they say, my fund is called VAS and is designed to match the ASX 300.
Okay.
Then another company, let's just say there's a Street Smart or something, I think it's called, might also have another product with another ticker symbol called STX, for instance. I'm guessing here, STX, that also matches the ASX 300. So if you were to compare between both of them, the only thing you compare will be the fees. Yeah, because their performance will be very similar. Now, there's a small margin of error because let's just say ASX, this Australian Stock Exchange, decides that the 300 company needs to drop off and then another company needs to move up. Then Street Smart might take 2 days to reshuffle their index. Vanguard might take 5 days, and therefore there's a bit of a delay there that causes a minor negligible difference. But these are two companies creating funds that match that indicator.
Got it.
Yeah.
And does that mean you could have like hundreds of funds trying to match?
Yes. In fact, there are hundreds of funds trying to match it.
So how do you know which one? Just fees?
Just the fees.
Okay.
Just the fees. And also the reputation of the company. Vanguard has been around for over
forever.
God knows how many years.
Yeah.
Whereas a new company might come in and then they might go, their fee is like a little less than Vanguard, but they just started. Then you want to go, are you okay with that?
Yeah.
Are you okay with that? Yeah, cool. Yes, and therefore, those words that Kath, the ticker symbols I gave you, VAS, VU, and VT, those are ETFs. Okay. Now, I will explain quickly what the ETFs and funds and the difference between them.
I was going to ask that question.
Yeah. So in Vanguard, you can go to Vanguard's website directly and say, I want to invest in your managed fund. Okay. call VA, let's call, I think it's called another ticker symbol for Vanguard that matches ASX 300. Now, if you do that, what you're doing is this. You are saying, I'll have an account with you, Vanguard, and I'll invest directly. My money will transfer to you. Yeah. And then you will do the investments for me. Yeah. And then if I need to sell, I'm going to have to go to you, request that I dispose of these amounts of assets. You will do it for me. And then it'll take you a few days. And once you've done it, then you transfer it to my bank account. So that's what a managed fund is. Yeah. If it's an ETF, yeah, underlying everything's exactly the same. But an ETF is traded on the stock exchange. So you can go to, let's just say, what's E-Trade or Commonwealth, whatever broker platform, yeah, and go to the Australian Stock Exchange and actually buy directly through the stock exchange. Now, that means your transactions are immediate because it's real time. There is no managed fund or manager doing anything of that for you. You are literally, I'm going to buy, and then within a few seconds, yeah, it's in your account. You bought it. Yeah? If you want to sell it, then you sell it directly, and within a few seconds, the money is in your account. So it's an exchange, can you say stock exchange? Traded fund, where you actually do all of that and you got full control and everything's happening in real time. But the difference, of course, is that if you go through a broker and do it that way and everything's happening in real time, there's a transaction fee that's probably higher than what you would have through a managed fund. Yeah. When I first started, I just used the managed fund. But today, I use an intermediary, and I'll show you what an intermediary is, where it's still traded on the stock exchange, but it's through an intermediate app that does it for me, because the intermediate app, like Raise, has so many consumers that they can do the transaction in bulk at once and share the transaction cost between a number of people. So your transaction fees are lower, but it's still through the ETF.
Yeah.
Yeah, which means the lead time between transactions executing is not as fast as through the stockbroker directly, but it's not as slow as through a funds manager, while still having access to a whole range of funds, because there are more ETFs out there than there are managed funds, usually.
Yeah.
Yeah. Does that make sense?
Yeah.
Yeah. Cool.
Can
Cool.
I just ask one question around
Yeah,
that?
sure.
So just so I've got it straight in my head, going straight to Vanguard, you buy off them, you've got your account with them. With an ETF, you're still buying
Vanguard's product. Yeah, but through the stock exchange.
Yeah. Okay, cool.
Yeah, you're still buying Vanguard's product, but through the stock exchange.
Yep.
Now, the fee structure might be a little bit different. In fact, I think the fee structure in ETF is lower than in the managed fund because Vanguard's not doing the management for you. Yeah. However, you might be paying more in terms of a transaction fee. Yeah, through the stock exchange. That's why I use an intermediary like Raise. Yeah, cool. All right. All right. Great questions, guys. And I didn't realize I had to know so much to be able to answer these questions because you are really put on my toes at the moment. Now, I will tell you, if I don't know the answer, I won't guess. I'll tell you I don't know, but I do know the answer to these ones. Yeah, cool. So I just did a quick, where is my, I'm going to share this screen. Yes, this one. Can you see my screen? Yeah, cool. So I'll give you the link to this. It's basically a really quick dashboard where you can actually go, where I actually went, right? I'm going to just put a couple of I'm going to put a number of start ages here. So 15. So if I was to start investing at the age of 15, 20, 25, 30, 35, 40, 45, 50, right? And if I was just to go checking in at the age of 60, so from 50 to 60, it'd be like 45 years on investing. Yeah. And what am I going to invest? $100 weekly. If I did that, if you have a 15-year-old child at the moment and you help them invest now, and slowly they start contributing, right? $100 every week. When they hit 60, they would have saved up. So this is savings, right? Saved up $234,000 saved up, right? If you were a little bit more savvy like my mom and you put it in fixed interest, now this is 2.5% is the average fixed interest for the last 30 years. because sometimes it's higher, sometimes it's lower, but average is about 2.5%, then you'd have $429,000, which is still a great sum of money. It's amazing, right? If you invested in the Australian index, this the VAS, you'd have $3,676,513. If you invested in the US index, which traditionally performs better than the Australian index, you'd have $4.1 million. Now, if you invest in the global index, you'd only have 1.7 million because the global index takes into account all the emerging countries plus all the third world countries as well. But still, if you decide that's what you want to do, it's still 1.7 million versus 234,000 versus less than half a million. Even if you did that, because for a lot of people, they go, I don't believe that US would be forever and ever the pinnacle of the share market performance. I think China will be next and blah blah. So they want to bet on global. Yeah, so they do that. Now, my super has traditionally been more global, 80%, but that particular mix has a larger percentage of US countries. Yeah, so I'm hedging my bets there. At the same time, outside of super, I invest in more US related investments. Okay, cool. So if we were to look at it in percentage terms, the comparison between fixed interest return and no interest return is 83%. Yeah. In the Australian index is 1471%. In the US is 165. In global return, it's 6.665. Now you can see that those numbers exponentially decrease the later we are, the later we do it. Exponentially. If we start at 60 and check in at 50 and check in at 60, then our amount invested will be 52,000. Fixed interest will only be about 8,000, 9,000 more. But if you go to the Australian index, provided that that those 10 years are quite fruitful, then you'd have 85,000 or 86,000. US index about 88,000, global index about 76,000. Yeah, so those are the percentages. And that's only $100 a week, guys. One coffee in Nanda, where I live, is now $6.50. And if I want to get soy milk, it's $7. 7 by 7 is $49 a week. So work it out, guys, and have a play with this so that you can actually see and imagine that if you were to do this, and all it is just change. Yeah, cool. All right, I'm gonna continue on. When I did this, right, I felt a bit sad. I felt a bit sad.
This is what I'm sad about because I'm only just starting to learn about this stuff now.
Absolutely, absolutely. I'm in my
Hey,
50s.
Tracy, I
Yeah.
turn 60 next week.
Yeah, I'm heading up there too, Christine. So this would have
There are
been
other
valuable
things.
40
I
years
think
ago.
Christine, yeah, I think Christine has got a property investment stream, and property is great because the leverage is so high. You invest this amount, and then when it goes high, and you know that, Tracy, too, you can get a lot back in a short amount of time. Yeah, but it does require things like management. I'm just lazy. I will be honest. Property, I just have limiting beliefs about managing it because I didn't know in the past that you could get property managers and stuff like that.
Yeah.
So I went this route. Yeah.
Yeah.
Cool. So it's going to be there for you. Now, let's talk about fees. Now, I also did a modeling, yeah, that showed that if you go index fund with a 0.1% fee and an active fund of 1.5% fee, in 20 years, the difference in your return would be about 32,000 versus 38,000. So fees make a huge amount of difference as well, which is why I think active managed funds are really not the way to go. This is, again, my personal bias. Yeah. First, they don't perform as well. Secondly, the fees are high. So it's a double whammy, which is why Q Super and the Australian Retirement Trust, they didn't offer index funds before. And recently, the bulk of their investments are indexed. Yeah, because it's easier for them too, because they don't have to pay for active managers. Cool. Okay. Now, this is if someone were to start asking me now and say, what would you do? I'd say immediately what you want to do is save 3 to 6 months of expenses in a high yield savings account, consolidate your super, review the investments in the super, make sure that your options are appropriate to your age, and then start researching some platforms for investing outside of super. Within 30 days, you want to get that done. Yeah. Then within the next 3 to 6 months, I'd say definitely open an investment account with one of these brokers or whatever. And I'll show you some examples. Start with index ETFs, yeah, or index funds, whichever one you want to choose. I choose ETFs now because there are so many apps that allow me to invest directly through ETFs. In the past, I couldn't. Yeah, rather than going through Vanguard, because it's a big company and these companies take a lot of time and you got to apply a whole host of forms and all the kind of stuff. I just don't need that. And then automate your contributions. If you're going to go $100 a week, just do a set and forget and go $100. No matter what happens, $100, because I know I can afford $100. If you can't afford $100, go $50 and stop having your coffee and make your own coffee for a little while, because it's worth it. It is worth it. Yeah. And then this is what's super, super important for me. Look at your investments, even when the amounts are small in the beginning, and be okay with the dips as well as the peaks. Because our mindset, by looking at a small amount of money dipping and going up, we ground our nervous system to believe that ups and downs are natural. It's just a cycle of the share market. Yeah. Then in the longer term, keep increasing your contributions. Now, a lot of experts say you should rebalance annually, which basically means, like in my super, right? If it's 10%, 10%, 80%, if one of them goes up to 90% because it performs better, then I would sell a bit of 90% to make sure the rest goes up to 10%. But there is also a lot of research that says if you don't rebalance, it's actually doing even better. So my super gets rebalances automatically every year. I don't have control over that, so I let them do it. But with my personal investments outside of super, I don't rebalance. Yeah. Then optimize for tax if you want, and then review your goals. Yeah. Cool.
That's
Now,
a question.
yeah,
So
sure.
when
Yeah.
you say, because I know when I was an employee, we had the super people coming in giving us talks all the time.
Yeah.
Even though we didn't really have a choice in the super, but all our supers were set at our age, like the year we were born. So if you were born in the 80s, you had this. If you're born in the 70s and so on.
Yeah.
So you said choose options appropriate for your age. I actually don't really understand what that means unless it's the amount of time you're investing.
So this is
what you mean?
Yes, a lot of accountants and financial advisors, this is what they tell you. They say when you are in your 20s and 30s, from the beginning, you can go like super aggressive. And then when you go into your 40s and 50s, right, you want to go moderately aggressive, like you want to go balanced. Yeah. And then beyond that, when you're closer to retirement, you want to go super conservative.
So again, does that mean in what you're investing in? But if you're just doing the index, if you're just doing the market, if you're doing the index,
so if you're just doing index, right, for myself personally, I wouldn't. I'm just going to go 10, 10 and whatever it is and just match the index. However, for some people, there's also index instruments for bonds and fixed interest.
Okay.
Where it just matches the bonds and fixed interest, which are very conservative investments. I don't know. Maybe, I'm not sure. I probably won't, but maybe if I turn 65, I might decide that my breakup is going to be more 20% for property, 10% for Australia, 30% for international, and then the remainder mixed between fixed interest index and bonds index. Yeah, I might do that. I probably won't. Yeah, I probably won't. I'd rather save the money, put it into a high yield interest account, which is a higher interest than normal fixed interest rates anyway. Yeah, and save it that way. That's what I want to do. Yeah, yeah. So this is interesting because there are super options that go, I'm just going to, based on your date of birth, and then put you into a particular bucket and then invest that way. I have never let someone decide that for me. I have always gone, no, I'm going to go with this. Yeah.
Changed now, but that's what it was. I didn't know any better.
That's right. And Jackie, that's true too. It also depends on what your nervous system is like. Because I know a friend who hadn't had a lot of super, but then she's gone consulting now and she's got good income coming in. And then she's saving a lot on the side. And then she goes, I'm going to go aggressive with my super. Yeah. I have a feeling with the way I am at the moment that I'm saving and having some bucket of cash flow in savings account and stuff like that, and my outside of investments, that my super will always be in that proportion. I will always be in aggressive. Yeah, but that's just me. That's just me. Yeah, because I've just seen how it's worked for me personally. If I hadn't gone fairly aggressive initially, I wouldn't have saved enough deposit to buy this place. Yeah, to buy this place. Okay, cool. Any other questions before we go to the next section? And then I'll shut up and then we can just talk through this a little bit. No? Okay, cool. Okay. Now, these are some of the things I hear. I don't have enough money to start. And it says here you can start with as little as $500. Do you know what? With some of the products I'm about to show you, you can start with $1. You can literally start with $1. And with one of the products, they say if you don't have $1,000 in your account, and it may have changed, but when I first started, it says if you don't have $1,000 in your account, we won't charge you any fees. We'll only start charging you fees when you're at $1,000. So there's so many products out there where you can start with as little as $10. Yeah. Every wealthy person started with their first dollar. The other fear I hear is I might lose all of my money, and that's what my mom has. I might lose all of my money. Investing in the top 300 Australian companies and losing all your money basically means the world is dead. Basically means even if you had the money, you probably wouldn't be able to buy anything. Yeah. So just reality check. Yeah. Just a bit of reality check. It probably means apocalypse. Time for zombie gear. Yeah.
And I always thought that was only, and again, this is only, I'm not expecting only recently from what I'm learning. That idea comes from the idea about active investing.
Yes.
Where that's because you lose loads of money, and rather than the indexing of a long term.
If you think Apple's the greatest company in the world and you invest all your money in Apple, then you'll be in trouble because all your eggs are in one basket. Yeah. But if you invest in the top 300 largest companies, and if all 300 largest companies go bust, then our problem is not the money in the investment account. Then there's bigger problems to look at. Yeah. Now, exactly. You're right, Tracy. And especially even in active investing, that's why a lot of managed funds also, you see here managed funds going bust as well. Yeah, cool. Now, investing is too risky or complicated. Simple index funds require minimum knowledge. It's a time in the market that beats timing the market. And if you make everything automatic, then it's just like super. It's just like another super. Yeah. Abundance mindset shifts. Money is scarce and hard to come by. Money flows naturally when I provide value. The universe is infinitely abundant. This is why I believe too. I keep providing value to you guys and do this like I did. Like I spent quite a few hours this morning doing this. Not because it's willy-nilly or anything, because I want to keep providing value to people I work with. And as long as I keep providing value, I believe the universe will reward me. It's just, that's my rule. That's my belief. That's just my belief. Rich people are greedy or bad. You guys know this. Money is just an amplifier. If you are greedy and bad, then you have more money to amplify your greediness and bad. If you're good and kind, then you have money to be even more good and kind. That's basically it. Yeah. I don't deserve financial success. Then we need to do lots of clearings about that. Because you deserve everything that the world and the universe can offer you. Yeah. Cool. Healing your money wounds opens you to true abundance. So if there's money ceilings, and I've had a few of those guys, when I hit my first 100,000 in my business, right, it took me probably about a year to be able to go up to 200,000, because what happened was once I hit about 130,000, then something shitty happens, like my car breaks down, and then I have to spend some money, like some energetic thing happens, or a client doesn't pay or whatever. And for me, if it happens 3 times in a row, then it's something to do with my energy and my frequency. Yeah, cool. The only way is up. This is the Australian shares over here. We've had World War I, we'll have World War II, we had crashes 1929, we had Korean War, Vietnam War, all kinds of crazy stuff happening, COVID-19. And can you see? The only way is up. Yeah, there are dips around the way, but the dips are far less scale-wise, relative-wise, to the big picture, which is the only way is up. The US market, the only way is up. World War I, influenza, post-war bear market, the Great Depression, only way is up. COVID-19, only way is up, the bigger picture. Yeah. The world index. Now, a lot more dips here because the world, all kinds of things can happen in developing countries. But still, overall, from 1970 to 2020, the only way is up. So everything else is a delusion and fear, I believe anyway. So if we think of investing as a lover, I think spend more time with your lover, yeah, and stop trying to time your relationships or control it. Know that there will be disharmonies and ups and downs in the relationship, but if you hold on to it with love and kindness and self-love, it will go up. It will go up. Yeah. Okay, cool. Now, I like the Raise platform. Why do I like it? Because you just have an app on your phone, and then once you're enrolled in it, the fees are a little bit higher, but it's very easy. You just set and forget. You set up every month, every week, or whatever it is, how much you can invest, right? And it's also got a really good feature called the set and forget roundups. The people who created Raise, it used to be called Acorn, and it's still been called Acorn in the US. They had to change their name because of trademark problems in Australia, but it's called Acorn in the US. Basically, this family, the father had always been a huge advocate for investing, but the kids were Gen I and millennials who felt like investing, COVID-19, blah, blah, blah. It's just all these things, stock market crash, it's just not useful. I won't invest. So this father then created an app that did what he called roundups. So what roundups are is this, and I did this for quite a while, I don't anymore, which is you link your app to your credit cards. And every time you pay for something with your credit card or debit card, every time you pay something, the app will automatically round it up to the nearest dollar. So if you buy something for $6.50, like a coffee, then 50 cents will be taken out and put into a bucket. And when the bucket becomes $5, then the $5 will be automatically invested in the thing that you want to invest in. So basically, it automatically does loose change investing for you. Yeah, and I really love that, especially for the younger generation, because it means they don't see the money going out. It's just loose change being invested. That is better than nothing. So I love Raise. The fee for the first, I think, $1,000, $2,000 is low, and then it goes a little bit higher, but it's really worth it. Yeah, and there's a good range of ETFs, everything from local to overseas and all kinds of stuff. But if I were you guys, I would just stick to, you can go, this is my recommendation. If you think you want to just go all in for Australia, then just go all in for Australia. If you want to go all in for the US, go all in for US. You want to go all in global, then go all in global. For me, I would go in the beginning, if I was to invest in that, I would go probably 33% Australia, 33% US, and 34% global. Yeah, so it's equal. And then you see how they perform, and then you get comfortable with it, and you might change your allocation later on or play around with the other ETFs. Because, for instance, there's an ETF on robotics and AI. You might decide you want to go there. Yeah, and that's okay because it'll be the top 50 companies that are operating in the robotics or AI space. Yeah, but also be wary of the rabbit hole of seeing the range of ETFs out there and wanting to have a piece in everything. Because by putting your money into the main three, you are having a piece in everything anyway. Yeah, because once the robotics and AI companies become more established, they will become part of the S&P 500 anyway. Yeah, cool. So that's the AT Raise. So I think you get convenience for a higher fee. This is Raise. Another one that's, hey, yeah.
Sorry, may I ask, why don't you do the roundups anymore?
Just because I don't need to, I'm investing a lot more. I'm not using Raise now because Raise was really good for me when I started, when I got a small amount of money, yeah, to do it. I can go directly to Trading 212 at the moment, which is what I use to invest directly into them with automations at a lower fee.
Oh, okay.
Yeah, at a lower fee. Yeah. So I guess this is my thinking. If you want something that's simple and to learn it, and while still being okay with a higher fee in the beginning, then go with something like Raise. Yeah. And plus the roundups as well. Yeah. Yeah, do it for a while. Yeah. So that was the reason why I did it. Perla is another one that's very popular in Australia. because it also has a super component if you want to go super with Perla. Good automations. However, the interface is a little bit more complicated. Yeah, I've tried it. The interface is a little bit more complicated. The fee is lower than Raise, and it's got a good range of ETFs. So that's another one to look at. Between the two, though, if I was starting off, I'll probably go Raise first. Yeah, if I were to compare these two. Yeah. Another one that's come up and coming. It's I think it was a US company, but then it's got a branch now in Australia. It's trading 212, and I quite like it. It's got good automations, easy to set up. It's got a global range of ETFs, lowest fee structure, because I think you don't pay a commission for any transactions, but if it's to do with, but there's currency exchange fees if you invest in like the US ETFs. Yeah, and that could cause some fees as well. I'm not sure specifically, but I really like it. Yeah, I really like it because there's automations there. And also, I love all these ETFs and I play around with it as well. So I go with these ETFs. Yeah. And you can see I can play around a little bit because I feel that my super is very static and very rigid and conservative in the sense that it's nice and clean and simple. Yeah, so I can play around with it. Mind you, I really want to say that one of my problems is that I need to simplify my investing. I should just stick to the top three. Yeah, just simplify it. Yeah, simple is easier. Yeah.
Do you
Vanguard,
use super in that as well?
no, my super is still with Australian Retirement Trust because because they've got low fees. And when I was about to switch to another index fund, which was Sun Super, because they have index funds and Q Super didn't have index funds at that stage, then when I said, this is what I said to the universe, there's no index funds. I need to pull out of that and go to one with index funds. Within a month, I got an email to say they've got a whole range of index funds products.
Oh, wow.
Yeah, so I stayed. So I stayed within this year. Vanguard is another one, but Vanguard is a funds manager. It does have its very popular ETFs, but it's traded via stockbrokers. And then there's minimum investment for funds, small number of funds, but very low fee as well, Vanguard. Yeah. Yeah. So I don't know. If you don't want to go the funds manager route, any one of these will be all right.
And Spaceship's similar to Raise anyway.
Yeah, and Spaceship is similar to Raise. Yeah, I've heard about Spaceship as well. Yeah. Yeah, there are others out there. I didn't put the other brands because I haven't used them before. I started 8 years ago, Vanguard index funds, because at that time, ETFs didn't even exist. Yeah, and at that time, the minimum investment for a fund was 5,000. You put 5,000 in first, and then you can have automated monthly investments. And at that time, I put $100, and that's how I saved up for my first deposit. Yeah, at that time. But then now, since then, ETFs have become really popular, and I've gone the ETF route. Okay, cool.
Can I ask a question, Andrew?
Yeah, absolutely.
You said where you're at is you'd like to go ahead and simplify and just focus on the top three. What did you mean by the top three?
So my top three will be Australia, US, and global.
Oh, okay.
What I suggested to you guys.
Oh, okay, got you. So
just like 3 segments.
Yes, okay.
Yeah, 3 segments. 3 segments. Yeah. Because I've also played the whole game of, oh no, I want to have some property. And then when I looked into it, out of the 500 top US companies, 10 of those companies are property and real estate.
Yeah, okay.
So you're already invested in some form.
Yep.
Yeah. Now, if I wanted to have a play at the moment, which I do have a segment, and just a small percentage, 5% in robotics and AI. Yeah, just because I also love the idea that I'm doing a lot of AI work, and I want to contribute towards these companies to keep investing so they can create even more stuff that will help me grow my business. Yeah. Also, I'm not a financial advisor, but at a point where you decide you want to do it, and then let's say you've gone to Raise and there's so many options. Yeah. Very happy to have a chat with you as well. Because even within Raise, we talked about the S&P 500, the US. They have 5 ETFs in there that all match the S&P 500. Yeah. So then it's about looking at the fees for each one of those and also how long they've been there and do it. Yeah. My rule of thumb is that if you have a choice and one of it is Vanguard and you don't want to do the research, just go with Vanguard. Yeah, because it's really established and they're also well known for having low fees. Okay. All right. I'm going to stop. I think I got one last slide. Okay. Your soul knows you're ready. Trust your inner wisdom. Take a line action. Financial abundance is not separate from spiritual growth. They support each other. Your investment journey is a practice of trust, patience, and self-love. Simple, consistent actions compound into extraordinary results, and every dollar you invest is a vote for your future abundance self. Yeah. So I think it's really, I had a little think about what my beliefs are, and these are my main beliefs. Cool. Okay. Have at me. You've been asking questions anyway, but have at me. Anything you want to share, anything you're feeling.
For me,
We did it again, Tracy. You go.
I just really want to thank you for doing that. It's really good. And I've definitely learned something. I'm just like going, I don't really know what my things are invested in. I just did sets, forget, roundups, and I don't even understand what all the things in the list are. So now I'm thinking, now I need to go away and really look at what I've got and what changes I might make.
Yeah, I love that. I love that. Get to know your lover.
Get to know my lover.
Get to know your lover. Yeah, get to know your lover. And it might mean that you already invested in all the right things, but now you have a peace of mind of knowing that, cool, you're setting it up for the highest likelihood of success and the highest likelihood of elevated returns, basically. Yeah. Yeah. Thank you for sharing, Tracy. Kath?
Yeah, I wanted to thank you too. That was very helpful. Thanks, Andrew. One thing I did want to ask about, and I don't expect it to be in depth here, but one thing I've never yet managed to tap into or do successfully or even understand is crypto. And
Okay.
I did during those COVID years, I don't know if anyone else ever heard of anyone else or had this experience. A whole lot of things got set up and I got burnt quite badly into two of those Ponzi or whatever they called schemes.
Yeah, Ponzi schemes.
Oh, yeah. So that really put me off. And I know that's not necessarily a crypto issue, it's a Ponzi issue.
Okay, cool. I can give you, I think we should invest a small percentage of our portfolio in crypto. I feel we should. Because I think, especially in terms of financial transactions, I used to pay $30 to be able to transfer some money to my parents. And it would take 5 days for the money to reach my parents, plus a huge amount of fee taken out by the banks.
Yes.
Now, because of the crypto platform and all kinds of stuff, it's 0.05% of it taken out, and it reaches my parents almost immediately because of crypto technologies.
Wow.
Yeah. So I think there is a place for crypto, not a huge amount of investment. So I'd go between probably 3 to 5%, of your, not your income, but 3 to 5% of your outside of super investments should go to crypto. And the easiest, fastest way for me, I would recommend, is to go to coinspot.com.au in Australia. Because in CoinSpot, if you look at their bundles, it's like an index fund because they have bundles, and one of the bundles is called Top 10, right? Which is the top 10 largest capitalized crypto tokens in the world. Yeah. So it's like an index fund for the top 10 cryptos. And that's what I invest every week. I just put a small amount, $50 every week, where it will invest into the top 10 cryptos of the world.
Okay.
Yeah.
And that must be,
yes.
sorry, I was just going to say that must be a respected platform because I remember a couple of years ago, a couple of people I spoke to said, yeah, good returns, but we can't get our money out. We just can't get it out.
And with any broker that you go to, and even the raise stuff, thank you for asking the question. I should have put it in. This is what I do. I put $10 in. I see that it appears in my account. I invest $10, see that it invests in the things that I want to invest in. I withdraw, I sell the $10, even at a loss, to see that it's sold and put into my account. And then I withdraw the remainder to see that it comes back to my account.
Yeah, okay.
Yeah. I just want to make sure that with every platform that I go to, that money can go in quickly and easily. They do what they're supposed to do, and I withdraw easily. And the $10, if I lose it, whatever.
Yeah.
So I always do it.
Yeah.
Just to check that I can, and also so that I can understand the process.
Yes.
And learn the platform. CoinSpot has been around for years, and it is one of those platforms that most financial advisors who advise people to invest in crypto suggest, just because it is Australian certified and with all the insurance and stuff. But most importantly, I like their bundles, which are basically their way of having index funds for crypto.
Yeah, okay. Yeah,
And
that sounds good.
Yeah, you'll see 16 different bundles for different things. And I think the one that I would focus on is the top 10.
Yeah.
Because they also have another bundle for AI crypto.
Yeah.
and
Okay.
another bundle for Australian crypto.
Yeah. Okay.
Yeah.
Okay. And are they quite straightforward to operate? Because I remember with these other ones, you had to transfer money, I think, into Binance or something, and then Binance would
Yeah,
transfer
no.
somewhere
This
else.
one, yeah,
Oh,
because it's Australian based, then what you do is once you create the account, they will give you a pay ID for your account or a BSB and account number with a reference for your account. So you can either transfer through your bank account or do a pay ID. Yeah. And then the money in the first time, the money takes a little while because they have to just check a few things. But after a while, if you do pay ID, you get money almost instantly into your account.
yeah.
Yeah.
Okay.
And then you just look at the menu bar across the top, look for bundles, and then click on the money that says buy, put in whatever amount, click confirm, and that's it.
Yeah.
Yeah. The only drawback with that platform is that there is no automation. So what I do is every week on a Monday, I have an item on my calendar, which is go to CoinSpot.
Okay.
Yeah. Then I go in and just do a click, and it's done.
Oh, as in to invest the money.
Invest, yeah.
Yeah.
I've already set up in my bank transfer that every Sunday it will transfer an amount of money into CoinSpot. Then on Monday morning, I go in, click, done.
Okay. Oh,
Yeah.
okay. So the money goes in, but then you have to allocate it to something.
You have to actually go in and decide to buy the cryptos.
Oh, got
Yeah,
it.
yeah, buy cryptos, yeah. Yeah.
Okay. Oh, that's
So
good.
so that's the only drawback. It's not fully automated.
Yeah.
But it's only like 5 seconds.
Yeah, that's nothing.
Only like 5 seconds. So that's the crypto investment that I would recommend. Now, I also do something else with crypto. I do grid trading with crypto. Yeah, but that's a subject for another story. Yeah, that's a subject for another story because there are advantages. It's great, but there are also disadvantages because every time you get an income from any sort of grid trading with crypto, you incur capital gains.
Okay.
Yeah. So the advantage for me is that I can have cash flow coming in if I need it, but it incurs capital gains. And then tax-wise, you want to have an accountant, and I do pay an accountant, and with their system where, because every transaction needs to go through in some automation system to work out what the capital gains is for the year and all that kind of stuff. Yeah. So
Okay.
I think it's way too complicated for what we need. I'd
Yep.
say definitely use the bundles.
Yeah.
Yeah,
Okay.
use the bundles. Yeah, for sure. Yeah.
Very helpful. Thank you.
Mm.
Yeah, this has been amazing.
Yeah, cool. I'm so glad. I'm so glad. Yeah.
Thank you.
Anything else? Any other questions? Christine, do you want to add anything? Because you're the investment pro here.
No, I play in property, obviously,
Yeah.
but I also do the options trading with
Yeah,
stocks.
that's
So
right. You got options. Yeah. And I haven't done the options part of it. I tried. It's too my brain or maybe the person who taught me didn't quite gel with me.
talk to me about that
Yeah. Cool.
another day.
Can I reach out? Yeah, I'll reach out and we might do a value exchange. Yeah, we might do a value exchange on that. That's beautiful. Yeah, cool.
Tonight's not the night, though. I'm way too tired to try and talk about it
No, we are
tonight.
finishing off anyway. Yeah, don't go. Yeah, absolutely. Yeah. Tracy, yes. Tracy Travis?
Hi, just taking the speaker off. I do a little bit of crypto, not active. Some of the banks will give you a bit of stick and ask you a million questions of why you're moving money around. Just stand your guns, but just be aware that moving into some crypto, they tend to want to know the ins and outs of a duck's guts. So if you're aware of it, you can.
What's your standard response when they say that?
I haven't done a lot myself, but I basically say it's my money and I'll do what I want. So
That's my standard response. So I've never been asked. Yeah, but I did set my account out quite a while ago, and I'm using an Australian bank to an Australian crypto
and
organization.
you're moving a small amount regularly.
Yeah, and I'm moving a small amount regularly.
I'm
Yes.
a member of a crypto organization. I don't do as much as I should do.
Yeah.
And I know when some of them move larger amounts,
Yes.
say their account gets put on hold, they get told they've been spammed and all the rest of it and try and put the wind up you. So I don't want to scare anyone. I just want to say that, sometimes like Wise or one of those, sometimes people move money to Wise and then to those just if the banks are being difficult. Anyway.
Yeah. So I think you're definitely right. I think if I'm at a stage where I'm moving that amount of money, they'll probably say something.
Yeah.
Yeah, they'll probably say something. So I think just like with Facebook ads, right? Yeah, where we get the first ad going and then invest a small amount of money and then you keep increasing it that way. Yeah.
I just wanted to give people a heads up that if you
absolutely.
think you've got something legitimate, all the rest of it, and the bank comes ahead, don't always trust the bank. Do your own research and just, rely on your own.
You have to remember that banks, that the crypto platforms and crypto tokens are in direct competition
Yep.
with banks.
The banks are worried big time, and I'm
Yeah,
being very
yeah.
polite
Mm.
about where their place in society is long term.
Exactly.
Very much.
But the thing is that they're not smart to adapt. They don't adapt soon. They'll be the next Fujifilm, the next
Blockbuster.
Kodak moment.
the next Canon camera. Oh no, Canon's still all right, but whatever.
Kodak.
Kodak, yeah, they'll be next Kodak if they don't adapt because they're charging us more and more fees for doing the things that actually don't require any fees, while they're using our money to invest and getting millions of dollars every second investing
For
and
my
still
money.
charging us for that, and us withdrawing money from ATMs and charging us for every single thing like that. They are setting themselves up for failure.
Yes.
Yeah.
And crypto used to be some fandangled thing, but some of the big players are actually starting to step into the space now. It's quite
And
interesting.
governments are regulating crypto, not in a negative way, but I think it's really good for governments to regulate enough of crypto to
US came
create
out
some
and
safety.
acknowledged it a couple of months ago with
Yeah.
the president. That was one
Yeah.
of the biggest changes in the marketplace.
Absolutely. Absolutely. So I think, definitely. I think crypto, one of my friend's kids and also one of my clients, she invested $100 in crypto when it was like $500 in terms of its actual value per unit. Yeah. She doesn't work now. Only has, she doesn't work now. She only has like odd jobs here and there, and she's an actor, so she auditions for work and stuff like that, right? But she doesn't need to work.
How good's that?
Because she invested at the time, and then it just like this massive boom. Yeah.
Something unrelated but related.
Yeah.
I've noticed lately, if you're going to do roundups with one of those apps that offers roundups, that I'm having issues because of multi-factor authentication for the bank. It might be the bank, it's probably the bank's problem. It's literally just started. So it's not, the roundup account's not linking. I keep getting all these notifications like, are you trying to log in? You're trying to log in. Like I get 5 a day. I'm getting them daily now, overnight.
Yeah. So this is what I suggest then, Tracy. Go with a bank just for that. Because what you can do, this is what Tracy's strategy is. Like I know ING has no problems with these roundups and all that kind of stuff, right? So go with a bank that has no problems with it. So transfer your money. Yeah. So
use a different account, basically.
Use a different account, yeah.
Yeah, for roundups.
Just use a different account for the round.
But this roundup part, not the other part, I don't think. Just
Oh,
the roundups.
So if it's the roundup part where
I don't get it.
So roundup has 2 components to it.
Yeah.
Yeah, the first component is which accounts are linked to have visibility of the transactions.
Yeah.
So that they can keep a record of what the roundup amount is.
Yeah.
That's the first part. Yeah. The second part is at the threshold of investing, where do I take the funds from?
Yeah, that bit's all right.
Okay. So the first one can't control that, unfortunately. Yeah. Unless you decide you want to change your bank for the credit card. Let's just say, I know 28 Degrees, for instance, had a lot of trouble with multi-factor authentication. So I have to decide then that I leave it there, and if it's a problem, it doesn't round up too bad. Or I can go, I don't want to round that account anymore. Don't worry about it.
Just put more money in.
Put more money in. Or the other thing is, that crazy freaking 28 Degrees and their problems, I don't like them anymore. I'm going to choose a credit card with not a problem, without that problem.
Yeah. Got it.
Yeah. So I think, so you're right. It's the first part that's a problematic one.
I've got loads of changing things financially because I've just sold my property and then I'm buying another property and it's going to be a different bank mortgage. And the only reason I'm using this bank account is because it was with my original mortgage. So I could just...
You could just decide that you can go because you sold them. It's the mortgage gone. And maybe it's just a sign.
Yeah, maybe.
Maybe it's a sign. Yeah, maybe it's a sign. Yeah. Cool. Any other questions before we finish up? Yes, Jackie?
Hello.
Hello.
I've just brought up my superannuation fund, and I was just checking because I was like, I think I'm in the indexed fund, and I'm in the indexed balanced fund.
Yes.
And when I'm looking at everything else that's available, it's like 40 different options, but there's like an indexed high growth and an indexed defensive. So are you saying I should go into the indexed high growth? So the index balance is actually not the good one.
The index balance will minimize the fluctuations,
Yeah.
but reduce the growth over the longer term.
Yeah. So it's middle of the range. It's medium risk.
Yeah.
Okay.
It's not as bad as index conservative, because index conservative will be like freaking 3% or whatever it is, 5% the most. Yeah. So
There's
you
also
want to go,
indexed growth.
Yeah. So index growth and index high growth. So high growth will be higher than growth. So
Okay.
high growth will be riskier.
Just
with
your levels of risk.
the level of risk. Yeah. Level of
Yeah.
risk.
Okay. Thank you.
Yeah. Cool.
And you won't believe this, Andrew. I
Mm-hmm.
had on my quest, my
Yes.
3-month quest, one of them was to do some financial education for my children,
Yes.
and you've just done it.
Feel free to show them the video, number one.
That's what I was hoping. Would you mind if I showed
Feel free to show the video. In fact,
with
what
your
I'm going to do
PowerPoint?
with this one, I actually had that thought. You wouldn't believe it. Before I turn on, I go, I'm going to put disclaimer in my YouTube channel. I'm actually going to upload this on YouTube.
Yeah, cool.
Yeah, I'm going to upload it on YouTube because I'm not giving financial advice, but this is something that I wish people had taught me when I first started my journey.
Me too.
Yeah, me too.
And Jackie, the link for that, the compounding interest, give it to your kids.
Where is that link? Because you forgot to put it in.
Yes, so I will put it in the platform as well. I'll add it into a platform down the bottom. So what the video, and then I'll put the link down the bottom as well.
So the video will get through Fathom.
No, the video you get through the Thrive Card, your learning platform, the usual one.
Yeah, that's what I was just wondering, my kids, because they're not.
I will give you, but that's okay. Once I put it on YouTube, they'll be able to see it as well.
Oh, okay.
But I will give you, but I will give you the link now. If people want to copy it, I'll give you the link to that dashboard. Now, I want to just really qualify that I just created that using AI today, this morning. And it looks like the numbers are correct, but I haven't checked every single number.
And I'm assuming it was based on an average. It didn't take into account true up and down a 40, 50-year period.
It did. So I got it to go in 30 years, every year's return. Add it all up, divided by 30.
Okay.
So it's an average return without the fluctuations.
Okay.
Yeah.
And sorry, I'm not sure this recording that we're doing right now, you're going to put that on YouTube.
Yeah, I'll put it on YouTube. Yeah.
Yeah, because I think your commentary along with the PowerPoint is necessary.
So I'll put this, as long as you guys are okay, because your faces will be there. Maybe.
Do you record it with different, you know how on Zoom it records all different camera versions? Like it might be
it won't
just
be
speaker view only.
So I think the best thing will be there. Your voices will be there. You won't be identified, but I will put the slides. Do you know what I mean? So the slides will show with me talking in the background.
Yeah.
Your faces. Yeah. And I won't mention your names, but as long as you guys are okay with that. Anyone with any reservations? Yeah. Okay, cool. So what I'll do is I'll bring into Descript, just so you know what I'll be doing. I'll be putting in Descript. Then I'll be creating scenes for when I'm showing those slides, and then dragging a JPEG of my slide over to cover the video. Yeah, so that you get basically a slideshow. Yeah. And if my recording's there with my face, I might put my face there in the corner. I'll see what happens. Yeah, cool. So I'll put the recording on YouTube then. Okay. Thank you very much, everyone. Have a great night. We shall see you next Thursday for office hours.
Thanks, Andrew. That was awesome.
Ciao. See ya.
Appreciate it. Thank you.
My pleasure. Yeah.